Welcome back to Investing Talk Podcast.
Today we're looking at Zeta Global.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We've got a lot to go through here with Zeta Global, especially with their recent earnings reports and what the analysts are saying. What really jumps out right away is just their foundational strength. The consistency is, well, it's impressive.
Consistency really is the key word, isn't it? When you look at their track record, what are we seeing that builds that kind of trust? Because, in this market, predictability is everything.
It really is. And we are seeing something pretty rare here. This marks the company's 17th consecutive quarter of delivering what they call a beat and raise.
17th.
17. And this isn't just about hitting a target. It suggests, a really disciplined financial operation that lets them consistently underpromise and then overdeliver. That's the core story for investor confidence.
Okay, so let's unpack Q3 2025 specifically. What were the top-line numbers that got them that 17th beat?
The revenue came in at $337 million. That's a very, very solid 26% growth rate year over year. And more telling, that number was about $9 million above the midpoint of their own guidance.
So they had plenty of room to spare. Now, I know they often break out revenue from, say, political ads and their live intent business. If you strip that away, what was the core growth rate?
That's a great question. It's a crucial distinction to make. When you exclude those more volatile streams, the growth rate actually jumps to 28%.
Wow, so the core business is accelerating.
Exactly. It confirms the underlying demand for their main tech services is getting stronger on its own.
All right, let's shift from revenue to profitability. Growth is great, but the market needs to see profit momentum too. What did the adjusted EBITDA look like?
The adjusted EBITDA saw a huge jump. It hit $78.1 million, which is a massive 46% increase year over year.
Yeah.
And this brings us to another pretty remarkable metric.
The margin.
The margin. It hit 23.2%, which marks their 19th consecutive quarter of margin expansion.
19 straight quarters of improving margins. That means for almost 5 years, they've been scaling up while getting more efficient with every dollar. That is not easy to do.
It really isn't. It speaks volumes about the operating leverage they've built. Once a client is on their platform, the cost to serve them just goes down over time, so the margin naturally climbs.
And that momentum must have fueled the raise part of the beat and raise. So what's the forward guidance look like?
They raised their full year 2025 revenue guidance to $1.275 billion. So still projecting that strong 26% growth. But more importantly, they also gave initial guidance for 2026.
And then what was that?
$1.54 billion in revenue for 2026. Now, it's important to note that number already incorporates the impact of their big Marigold acquisition. And I should also mention Q3 earnings per share was $0.20, which was a nice 11% beat on estimates.
Okay, but let's talk cash flow. I think in this economy, cash generation is maybe even more important than some of the other metrics.
I completely agree. Free cash flow, or FCF, is the real money left over.
So how did they do there?
Q3 FCF was $47 million. That's a staggering 83% increase year over year, which translated into a record 14% SDF margin. It's highly impressive.
And their full-year outlook for cash is stunning. The guidance is what, $157.4 million in FCF for 2025? That's 71% growth. Plus, the balance sheet looks super healthy, a current ratio of 3.0 and almost no debt.
That financial foundation gives them so much flexibility. And this brings us to what they're doing with all that cash. I mean, despite really high gross margins, around 60.8%, they're not focused on things like dividends or buybacks right now.
Which immediately begs the question, why not? If the cash is flowing, why not reward shareholders?
Because they're playing the long game. The focus is 100% on growth and building out their competitive moat. They're reinvesting everything into their platform and, critically, their proprietary AI, Athena.
Okay, that is the perfect segue. The MarTech space is incredibly dense. You've got these huge players everywhere. What is Zeta's moat that prevents a giant from just coming in and replicating what they do?
It's all about proprietary data being orchestrated by AI. It's not just having AI, it's the unique massive data set that feeds it. Their Zeta marketing platform, the ZMP, uses this to drive really high net revenue retention rates.
Meaning clients stick around and spend more over time.
Exactly. It's not just a box of tools, it's an integrated system. But let's focus on Athena specifically. We hear proprietary AI from every tech company. What's the verifiable advantage here?
Right. What makes it sticky?
Well, Athena is the intelligence layer for all client ad spend. And its advantage is that it delivers measurably superior returns. We actually know this because an external Forrester study validated its performance against other options.
And that external validation is everything. If a client knows leaving Zeta means a lower return on their marketing budget, well, that creates huge switching costs and makes the platform essential.
Precisely.
Yeah.
And the more ad dollars Athena manages, the smarter it gets. You get this powerful network effect. It just keeps strengthening their position.
So how does the Marigold acquisition fit into this? How does that accelerate the Athena advantage?
Marigold brings in a flood of new clients and, more importantly, new data sets. More data means better training for Athena, making it smarter, faster. And while this is just speculative, the rumor is that this integration could dramatically speed up their path to AI profitability.
Interesting. Okay, let's switch gears and look at the market reaction. The stock's been exceptionally strong lately. It was up over 4% just recently, and it's had a, 57% gain over the last 6 months? That is a huge run.
It is a massive run, especially when you see the 52-week ranges from about $10 all the way up to $38. The price action is very constructive, and technical analysts are seeing some really bullish patterns emerge.
What specifically are they seeing in the charts?
They're pointing to things like mid-channel oscillation and a clear momentum breakout. In simpler terms, it means the stock is moving predictably higher in a defined channel and just gained the velocity to challenge the top of it.
So they're seeing exceptional risk-reward setups.
Exactly. Some analysts are targeting immediate potential gains of 23% to almost 25% from current levels. The technicals seem to be validating the strong fundamentals.
And all of that points to accumulation, usually by institutional money. Where's the key support level that investors are watching?
The big one is the 200-day moving average. It's sitting around $15.80 right now. The fact that the price is holding well above that suggests big institutions are consistently buying in that zone.
And the numbers back that up, right? Institutional ownership is huge, nearly 88%.
Yes, the cluster buying is very clear. For instance, Truist Financial just started a brand new position, and Wilson Asset Management upped their stake by over 6%. When you see smart money making fresh bets after strong earnings, it shows a lot of confidence.
And that confidence is definitely reflected in the analyst outlook. What are the price targets we're seeing from the big firms?
They're high and they're rising. BofA has a target of $24, D.A. Davidson is at $27, and RBC just raised its target from $28 all the way up to $30. The average consensus target is sitting right around $29.54.
Okay, we've built a very strong case for the bulls here. But we have to address the risks. What's the bear case? What's the main concern that keeps some investors on the sidelines?
The primary issue, the real tension point, is profitability, specifically the difference between their adjusted EBITDA and their GAAP numbers. While adjusted margins are expanding, they still reported a GAAP net loss of $3.6 million in Q3.
And that's the conflict, right? For listeners, adjusted EBITDA excludes things like stock-based compensation. Why does that GAAP net loss matter so much if they're generating all this cash?
It matters because a GAAP loss is, by the book, the truest measure of profitability. It means that the cost of high growth, including all that stock compensation to keep top AI talent, is still outpacing their ability to generate net income today. For a certain type of investor, that's a red flag.
So what's management's response to that? How do they justify it?
They've laid out a very concrete long-term goal. They are targeting a really aggressive 30% EBITDA margin by the year 2030. They're basically saying, we have to spend this money now to build the AI dominance that will unlock incredible efficiency later.
It's the classic growth trade-off. But 2030 is still a ways out. Are there any other risks to consider in the meantime?
Well, the other risk is just stock volatility. For example, even after that great earnings report, the stock actually dipped 5% right after. It shows how sensitive it can be to market sentiment and profit-taking.
Right. But I guess the analyst's argument is that those risks are already priced in, with the stock trading in the, $17, $18 range compared to those much higher price targets.
That's the argument, yes, that the potential upside already accounts for the near-term GAAP concerns and volatility.
Okay, so let's look at the calendar. What are the immediate catalysts we should be watching over the next 3 months?
The most immediate one is the Q4 2025 earnings report. That's expected in early February 2026. The consensus EPS is at $0.16. But given their history of big beats, Q2 was 133%. Beat expectations are pretty high.
And what about the Athena AI timeline? That seems to be the centerpiece of the whole strategy.
That's probably the biggest fundamental driver to watch. The client beta testing for Athena is set to end by Q4 2025. That means a full production rollout is slated for Q1 2026. A successful transition there would be a massive signal for future growth.
All right, so to wrap this all up, The investment thesis is built on sustained excellence, 17 straight beats, a core business growing at 28%, and just record free cash flow. The key differentiator is that Athena AI platform, which is about to go mainstream, and you have incredibly strong institutional backing.
And it seems analysts are suggesting two ways to look at it, either as a shorter-term swing trade heading into those Q4 earnings, or as a multi-year hold, banking on that projected 20% compound annual growth rate.
It really creates a fascinating dilemma. They're sacrificing today's GAAP profitability for a shot at that huge 30% EBITDA margin by 2030, all powered by AI. And for you, the listener, the ultimate question is, does that long-term payoff from AI dominance justify the current lack of net profit? Definitely something to think about.
And with that, we wrap up our analysis. Remember to subscribe to the podcast for all our future market analysis.